When it comes to the topic of inflation, many don't fully understand the term. They are often put off by the complex definitions they find online. Here's a simple explanation that may help. Ever heard a story from your grandparents of how things were very much different 40 years ago? Things were somewhat more peaceful and much more cheaper. They boast about how in their time, $5 could have probably gotten you a decent meal, but that same decent meal, or less than that, might cost you $10 or more today. They also boast of how they could have probably purchased a house for a quarter of the price it is today. That is the power of inflation. In simple terms, inflation is the increase in the price of goods and services, as well as the decreases in the value of your money, essentially a decrease in its purchasing power. Let us look at it this way. A good cup of coffee from your favorite cafe might be $7 today, but 2 years later you probably need to pay an extra 50 cents to get that same cup of coffee. So why does inflation happen? Well, one reason is cost push inflation, which simply means an increase in the cost of a business is pushed onto its customers. If raw materials like grain or wheat needed to make flour become more expensive, businesses will have to incur additional prices on their customers to prevent them from going out of business. A second reason is demand inflation, which is when demand for goods and services rise faster than they can be produced. If we all generally have more money, that would mean we'll be able to offer more money for the same goods and services at the same price. That increases the demand for such goods and services faster than they can be produced. As a result, prices increase and all of a sudden you need more to get the same house, which could put you out of the competition to get it in the first place. The third reason for inflation is the printing of money. Governments keep a close eye on inflation rates and manage it closely. The printing of money is done in an attempt to stimulate or save the economy. In the short term, this can produce a positive effect. However, long term, the money gradually decreases in value, and instead of the money enabling you to buy more, it just pushes up the prices. This is very risky and has backfired in the past. So why is inflation a problem? Well, because when it occurs, not everything increases at the same rate. For example, prices of goods and services may rise, but incomes remain low, which can cause serious financial hardship. So as you can see, inflation is bad for savings, primarily because it attacks its value and its purchasing power. This is why people should probably consider investing, as it allows you to keep up or even exceed inflation, and it is a great way to ensure your wealth is preserved.